Hello and welcome to the India Hangout. The Union Budget 2014 has made a lot of promises. One of them is almost 60,000 crore of disinvestment proceeds or money raised through the initial public offer or follow-on public offers by selling public sector units and their stakes or other stakes in public sector units to the public at large, which might include institutional investors. The question we are asking, however, is this likely to go forth in the manner that it was conceived and hoped? That's number one. Secondly, what could it do to the stock markets? Are they in a healthy in the healthy enough position to absorb all of this, or could there be problems? And thirdly, what will this do overall to these companies which are being disinvested, and what does this mean for the overall disinvestment strategy? With me, Andrew Holland of Ambit, and Uday Ved, the tax consultant. Gentlemen, thank you very much for joining us. So let me quickly begin with you, Andrew. So 58,000 crores, almost 60, let's say 1,000 crores. Now this number is the highest ever projected. I was looking at a table here which says that from 2005 to 2014, there's never been this kind of money ever raised from the stock markets by the government through disinvestment. On most years, actually, the best case has been about 25,000 crores. Things have, of course, changed, but have they changed enough is the question.
Yeah. No, I think so. I think the government can, whether it's going to be in the whole of this year, but I think capital markets are ready for India. I think this is India's moment. So I'm not going away from the fact that we are in a bull market. Where I've been differing from a lot of people is against index targets. Because you have quite a large percentage of your index which are in defensives, which is IT, pharma, and consumer goods, which are all trading at very high PEs. So I think earnings will catch up with their PEs. Now, for the rest of the index, you've got 30% in banks, and that's exactly where you're going to see a lot of paper coming over the next 1 year. So I think the index probably doesn't do so much because of all of this paper. It will absorb it, that's for sure. Because I think we're going to see the India growth start to get towards 7% GDP growth, and the operational gearing in India in terms of profits is going to be huge. So I can see that the markets are taking a pause at the moment. Expectations were very high before the budget, but we still have to get some big policy, big bang reforms coming through. So in the next 3 to 6 months, I think we'll start to see that, and that's where the divestment will happen.
Right. So the first question now, in taking up from what you're saying, will this, if it is indeed the government is indeed able to push through with this volume of paper into the market, will this crowd out other investment IPOs rather from the private sector, and could that crowd it out to that extent?
I think IPOs no, because I think there'll be different companies within different sectors outside of say the banking sector, which is going to be the large portion of divestment by the government, and you're going to get QIPs. But I think what the market will do now is that in this kind of rising tide, all boats have kind of moved up in one go. And I think now we'll start to see us differentiate between the good companies and the bad companies, or the ones with better growth.
Right.
So I think those companies will be able to do their QIPs.
Right. So you're saying that there's a very strong rising tide. The tide's been rising for a bit. It will lift both the public sector units who will come with their public offerings, as well as private sectors who may have been waiting in the wings for a long time.
Yes, I think that will happen.
Right. Okay. Uday, take us through broadly what the tax environment is from an investor who wants to come in at this point. How have things changed for long-term investors at this point?
So Govind, if you look at the individual investor, if you look at 2 or 3 things which have happened, it may look very small, but I think it is a huge impact in my view. The exemption limit going up from 2 lakh to 2,50,000, or the raising of this ATC, LIC, PPF investment going from 1 lakh to 1,50,000. If you look at today, about 3% of the population is in tax net, about 3.5 crore people. And if 70% of that were to invest, I am taking point from what Andrew said, 50,000 extra in PPF. I did some rough maths. A 2 crore people investing 50,000 is 100,000 crores that can come in the market. Same way with exemption.
But you're saying that it will go to PPF and then it will
it can
also
go to
come to...
It can go to PPF and then it can come back,
potentially.
Come in the market. Second, exemption limit going up will throw some extra tax savings. And on a 50,000, I'm just saying, it comes to 5,000 rupees a person. On a 3.5 crore people, it's some 18,000 crores. Again, the number may look small, but what it will do is also bring better compliance. And if there's a better compliance, there will be money more in the market. More savings will come in the market. And I think that's why, be it a PSU divestment or individual companies going for IPO, the market is good, because I think the overall environment is positive and people. So this is more on the individual side.
Yeah.
On the corporate side, something
Let me
similar
ask
will
you one
happen.
more question on the individual side, and this is what I'm trying to understand. So you have a supply and you have the demand. So are you saying that this budget in that sense has managed both sides or created the environment for both sides?
Yes.
Supply side is allowing public sector units to and defining the roadmap for them. On the demand side, making it easier for investors and giving them that little more.
Absolutely. I think I'm just saying of the small investors, and small investors constitute a big part of the market from an individual perspective. So I think definitely more money in the pocket will go into more savings. And if you look at the savings rate, it used to be 37% maybe 5 years back. It's dropped to 30% now. 30.1 is what economic survey mentioned. And I think that this will also take the the savings up, and that money will come in the market. And plus, I think the better compliance, I think that's a larger issue in my view. A better compliance will bring more people in the tax net. If more people come in the tax net, then this money will come in the formal channel today, which is maybe in the parallel economy.
That's interesting. And you were saying on the corporate side?
On the corporate side, giving benefits to the corporates on, be it on the infrastructure side or on the investment allowance. I'm just made one or two things come to my mind instantly. That will possibly add to more profits, and if the corporates do well, that money again will be available. So I think the more purpose is to seeing more profits available to the corporates also. That money again will come, in the business. In the business, it will come in the markets both ways. That's the way I look at it.
Right. So, Andrew, are you interpreting this similarly? A much more vibrant capital market scenario with more money in investors' pockets, with more paper about to arrive?
I'd also add that the finance minister's also made it not as attractive to being fixed maturity products as well. So that will obviously see a shift towards equities.
Right.
And in terms of the residential market, again, he said you can only on your own one individual property tax exemption. So again, it's going to stop us all speculating in property. So it's actually moving us away from debt. Fixed income and gold, obviously, people have moved away from back into equities, and I think that's the backdrop to a better capital market.
Right.
And again, just one more point I'll make it. Look at those, the finance minister did make a statement on the real estate investment trust and the infrastructure investment trust, right? SEBI has come out with the draft guidelines on that. And once the rules are out, if you look at, they've created an entire pass-through structure. That means the tax will be only at one level, either at the SPV level or at the shareholder or the unit holder level. This money again will come from both the individual investors as well as the corporate investors. Money comes in that, get invested in the market, get invested first in the project, and then come back in the economy. I think those again will be a huge impact as and when it comes up. Because today there are draft guidelines on the they're what they call business trust.
Right. Andrew, if we were to look at the state of the capital markets today, which is obviously much more vibrant than ever before, the government is. The government's promise or desire to raise money, however, is linked to its gap in revenues or a gap in the fisc. Now, is maybe the capital markets don't care at this point of time, but is that something that's going to be a concern going forward? That all this is eventually being only done to fix a gap or a hole in the fisc rather than a very strategic, long, sound disinvestment stroke, maybe privatization program.
Yeah, what's wrong with that? I mean,
nothing wrong.
There's nothing wrong.
Yeah.
So I think the markets will give them that 1 year breathing space, and hopefully we'll start to see GDP start to accelerate, and then if corporate profits start to increase, then the tax revenues will start to increase as well. So it's all about growth. You've got to get your growth going, and so I think we'll give them a year to get that going. I'm less worried about that. The fiscal problem than I was, say, 8 months ago to 12 months ago. So I think we'll give them 1 year. But the more important thing is, can they bring in foreign direct investment as well? And that would be the key. If they can bring that in, I become less worried about the overall economy growing, because that's really what India needs now.
Right. So let me flip the question. What kind of appetite do you see in the markets in the next, let's say, 1 or 2 years for fresh paper, both from the government as well as from the private sector? Again, if you look at the kind of numbers that we've seen in the last few years.
Well, we're seeing on average now, foreign investors pumping in around $20 billion. I could see that kind of, $20 to $30 billion for the next 2 to 3 years quite easily. And then you've got foreign direct investment. And don't take away that multinationals offshore will want to play in the domestic Indian story.
Right.
So, M&A could play a large part of what the Indian story as well. We've already seen it with a lot of multinationals before Modi took over in terms of buying back their own shares. I expect more of that to happen.
Right. Now let's come to the companies in specific, right? So there are, there are some obvious suspects. There's Coal India, Steel Authority of India, ONGC, PFC, REC, and so on. Now ONGC alone, 5% could raise maybe 18,000 crores, and so on and so forth. Now, what is this going to do to the companies and the perception of them as investable entities over the medium term, if not long term?
Well, hopefully corporate governance comes in line with that. And I think the government's talked about having more governance and more accountability at these companies. I think that would be a welcome change for us all. Because in PSUs, you've always been worried about government interference, the ability for management really to make some hard decisions. I think, from what I've heard, the government's ready to take those hard decisions now, and please let it happen soon.
Okay. Uday, how do you see this? I mean, the overall ability of government to let go and let maybe more professional boards and CEOs manage companies.
I think it has to come. We've been talking for last maybe 7, 8, 10 years on the divestment of PSUs.
Yeah.
It's not worked, and very clearly this will be it's all gold kind of companies which will really go. And so the good governance, bringing more and more transparency in the boards, I think is going to be the key. If you look at the foreign investor, whether it's an FDI or maybe in this situation FII or FPI, again they will like to make sure that there are the good boards, governance boards. From a tax perspective, as you were saying, there is a great clarity which has come in this time, and that could help. So the situation is you have an FII which is investing and as a fund manager. Till today what they used to do was, a fund manager in India, could that constitute a business presence and a taxable presence? And there was always a question of whether this will become, finally capital gains or a business income. And most of the people used to keep fund managers abroad. Now, this time, finance minister has, and the finance bill has specifically clarified that any investment by FII, with or without fund manager, whether in India or overseas, the characterization of income will be capital gains. Now, that bringing certainty will also help FIIs to invest in the markets. What it means, once it is capital gains, if it's a long term, more than a year, it is tax free. Short term is 10%. And if you come through those favorable tax jurisdictions, like today Mauritius still stands as a route, or a Singapore, then it's tax free. So that to that extent, even FIIs and FPI will have an ability to invest in this with more certainty. And so I would believe that funds will again flow in this way. That I'm not saying not necessarily only from a PSU divestment perspective, but in a larger capital market itself.
Okay.
And we would see that.
Right. So, Andrew, there's a question for you from Amit Shah. He says to Mr. Holland, when do you think more than 50% of our young population of 1.277 billion will actually get into equities?
I think there's more products than there was. Even when I first came here many years ago now, there's saving investment products. I think mutual funds, have played a part. But now, our firm has launched an alternative investment product as well, which is a hedge fund. So there's a lot more available for investors across different avenues, whether it's going to be a REITs, or whether it's going to be alternative funds, or whether it's direct equity. I think there's going to be plenty of opportunities for investors to get invested, and maybe the insurance products won't play a bigger part going forward in that for investors. So I think mutual funds, saving investment products, alternative funds, and maybe real estate products as well. So there's lots of areas you can now invest in.
Right.
And I think as interest rates fall, which we expect to happen in 2015, then equities become a more favourable product as well.
Right. So I mean, obviously, because we've had a drought of sorts for so many years now, and in terms of real sort of retail participation in capital markets, and except for the last 6 months, even the market's going anywhere. There's no real benchmark to look and compare with. So how does one build this scenario, which of course looks very bright, but how does one get to the point that one can say that yes, there will be so much participation, there will be so much paper, there will be so much so many incentives floating around and all this happening?
I think we just have to think about where India is today and where you expect it to be in 3 to 5 years' time. Now, if you think the economy is going to be where we are, then obviously, there's,
Sure.
equity markets are going to follow
Only a reflection
suit.
of that. Yeah.
But we're expecting GDP growth of 7%. We're expecting earnings growth of 20%. So look beneath the index and look and say 3 years' time. If you're investing in infrastructure today, who's the suppliers? Who's going to supply that infrastructure? Whether it's from railway tracks to wagons. I mean, someone's going to have to supply that. So you're going to have to look below the index, and that's what I would advise investors. Look below the index. Who's going to supply India? It's a domestic Indian story. If you look at 2003 to 2007, speak to any foreign investor, they'd say India was categorized by the outsourcing story. This time around, growth is going to be domestic India. And in 4 to 5 years' time, all the foreign companies will be just wanting to supply India.
Right. So if you were to look at now again going under the index or below the index, as you said, what's the general health of some of these companies, including those which might come with paper in the public sector space? Are they all equally healthy? Of course, many of them are monopoly and therefore would be healthy to some extent. What should an investor be looking out for, and how should an investor be making their wish lists and so on?
So I think you've got to just look at the infrastructure story of where is the government going to focus its efforts. Obviously, roads, it's already talked about, giving huge amounts of contracts out in the budget straight away. So you can look at EPC contractors there. It's very simple. Ports. Again, who's going to supply ports? Who's going to be the suppliers to ports? So again, you can look at certain companies within that sector. So again, just look at the sector and then try and find which company, because not all companies are going to be the winners, where you have reasonable, clean management, transparency, and obviously, are not hugely indebted, because those are the companies where there's still going to be problems for them. Yes, they will be able to raise money, but you want to go with companies who have got a strong balance sheet now, strong management now, who'll be able to ride into that wave of orders which we expect to see over the next 2 years.
So you're saying your primary bet is infrastructure and infrastructure-linked companies?
Yes, exactly.
Okay. Uday, how does it look to you? The forthcoming period, which seems to be quite rosy.
If the economy has to grow, I think you first need to put the infrastructure in place. And I think we've spoken that for last 5 years, 7 years. A huge amount of fund can come, right from $350 billion to maybe $500 billion. And this government specifically wants to address that situation. Look at 100 smart cities that he has said, right? So if you look at the infrastructure, that's going to be a thrust, be it roads, be it power projects. He's again given tax holiday to a power project, extended by 3 years if you start that project. And a lot of thrust is on infrastructure. So I think once the money really comes, that's going to be the key story in my view also.
Okay. So Andrew, what's the unfinished agenda here? What remains to be done from an overall capital market point of view on the supply and the demand side for some of the issues that we've been talking about now, or the companies that we've been talking about?
I think the market wants us to be 5 years hence and have benefited from everything. There's some big outstanding issues out there like GST, subsidy sharing. And I think if we can clear up those two over the next 3 to 6 months, I think that will give the market the lift it needs and give confidence back to India Inc. that things are moving forward. So I think those are the kind of things that I'm looking for now. The roadmap I don't think was ever going to be done in the budget. I think the roadmap is still to come out. But once we start to see that, and what we haven't really had is Modi come out and say, here's my vision, here's what I'm going to do. I'm sure that's going to come. I'm sure he's waiting for a certain moment to do that.
Right. So so there would be some concern that the 25,000 almost in the Sensex or the 7,400 in the Nifty that's been built up was built up on something, on a premise that things are going to happen and therefore people were feeling bullish.
Yeah.
And if that does not happen at the way it did, it could also derail all of what we've just talked about.
But it will happen because it has to happen.
Sure. No, I'm just saying as a concern that could be one of them.
Well, you see, we're looking at 5.5% GDP growth. We haven't changed that since last year. Right? Even though Modi came in with the mandate he has. So we're saying that it's going to be a similar growth patterns to say from 2003 to 2006. 5.5%, then 7%, and then hopefully better growth after 2016-17. But the operational gearing for India, if you move your manufacturing capacity from 60% say to 70%, the amount of earnings that generates is just huge. And you just have to look at some of the companies that have managed to benefit already from operational gearing. The financial gearing is when interest rates come down. So that's a 2015 story. So the earnings story for India is starting. And what it needs is just some of those projects which have already been cleared to be kick-started or rebooted.
So you're saying fundamentally most Indian companies are in a good position, even though the expectations might be high and the stock market may be at a high level and so on?
I don't think the stock market's at a high level.
And if you were to look at earnings, okay.
Right. So, what I'm saying is that, the market's moved up, 20% this year, right? And we take off 5%, so 15%. I don't think that's a big move in a longer term bull market. Earnings are the PE is being held up high because of 3 or 4 sectors, which are your defensive sectors. If you still look below those sectors, and fast forward 3 years, there's still some great value to be had in the kind of commodity companies, metal companies.
Right. So some more questions again for you. So here's a question which I think will also put things in perspective. What's your view on the Chinese economy? In the sense, maybe I guess the question is as much about China as about saying that, okay, where do we stand in the competitive landscape for capital?
So I think China is, listen, China has a problem with transparency, and I don't think, if you ask anybody, no one really knows what's going on. The way I look at China is it's very simply, because I can't get into the details, is the stock market's telling me something. The stock market hasn't moved now for the past 4 or 5 years. In fact, it's down more significantly than India, and it's still not moving. So there's something that's happening within the economy, whether it's shadow banking, which we don't like. And maybe that's why bond yields are so low globally as well, because there's something in China happening that we don't like. So that's obviously one area that is always on our radar, but more for concern rather than growth. India is going to be the only domestic growth story which foreign investors are going to look at. It's not going to be China.
Okay, great. Uday, what's your sort of last word on because we started with a lot of anticipation and expectation before the budget. We went in, the markets have largely stood. A whole bunch of things have come in from a tax easing point of view, particularly for individual investors. The state seems to be set.
Yes, definitely. I think one has to look at the long-term story. Budget cannot be the medicine for every evil, right? And in that sense, I think it is going to be how the things will move over next 3 to 6 months in terms of reforms process or bringing a GST. Maybe it looks like an unfinished agenda today, but he couldn't have done GST because there are some compulsions, right? I think government is in an absolute majority today. The last thing you want to do is to know GST law not getting passed. So I think once he has that comfort, GST said it's a question of when it will happen, it has to come to an end. So I think that's a one unfinished story. The other thing which is a bigger issue in my view, equally bigger issue, is this entire issue of black money, okay, which has happened. And that's a parallel economy which is going on. I think creating that confidence, that trust, okay, that certainty, the stability. And for the honest taxpayers, I think if you and me and everybody is paying the full 30% tax, why should those people, promoting dishonesty, in terms of black money? And so I think that specific, of course, the government has appointed a special investigation team, and that couldn't have possibly been done in the budget. So it will again, how things will move, will create more transparency. And the issue is, if that parallel economy was to go, automatically this money will come in the in the mainstream.
And also take this issue by the horns is something that we've never bothered to really.
Just take it head on.
We all assume it's always been there, and it's nothing we can do about it, and so on. Andrew, one more question. The question is actually, is this the right time to buy PSU banks? So, and let me reframe that to you, saying that between banks and let's say minerals and oil companies and power companies, what's your favorite?
I would buy metals rather than I'd buy PSU banks. There's going to be a lot of issuance, and you've got to work out what discounts the government's going to give you. So I think you've got plenty of time to buy the PSU banks. I mean, they need to raise huge amounts of capital, and a lot of the problems are still there with those banks. So I'd probably be more the private banks than I would be the PSU banks, as usual. But if I had to kind of say where would I put my money right now, I'd be the metal stocks.
Right. I think we've run out of time completely. Thank you so much for joining us on this special discussion on how the government will raise the proceeds that it wants to raise through disinvestment, and of course what this means for the markets and the capital markets overall, and for other private companies wanting to come in. Thank you very much for watching this Business Standard special on India Hangout. Thank you.
Thank you.